Have you been asked to account for goodwill and have no idea what it is or how to calculate it or how to journalize it? Well, you've come to the right place because I'm Professor Capko and I'm going to make this super easy for you in this video. First, I want to mention I believe something great is going to happen for you today. And now, back to the video. What is goodwill? Well, we're not talking about the place where you can make donations or buy some previously experienced items. We're talking about an accounting term. The accounting term is goodwill. And what goodwill represents is when one company purchases another company. In this case, we're going to say the takeover company is purchasing the target company, and they pay more than the fair value of the net assets. That additional amount paid is called goodwill. Let me make that a little bit more clear. If you take all the assets a company has that is for sale, and if the company itself is for sale, and you add those up and you subtract out any money owed, which gives you net assets, right? If you take the amount you owe and you take it away from the amount you own, that's going to give you owner's equity, which is the same thing as net assets. And that company's for sale, you calculate the net assets, and the company that purchases it pays more than that net asset value, which is fairly determined. Well, that additional amount is called goodwill. Why on earth would a company pay more than the net assets? Well, there's a lot of reasons, most of which surround the reason maybe the company is purchasing the other company in the first place. Maybe it's the name value, maybe it's a recognized name, maybe it is has an established customer base that they want to keep, and maybe they've got lots of profits coming in that are higher than maybe a competitor with the same amount of net assets. There's a lot of reasons why more than the net asset value might be paid for a company. So for definition purposes, the goodwill is going to be the amount paid above the fair net assets value. So in this case, we have a target company, and that doesn't mean target the store. It just means that's the company that's the target of the purchase. And we have a takeover company. The fair value of the net assets of the target company is $100,000, and the takeover company is going to pay $150,000 cash for it. How much is the goodwill? Well, they're paying the $150,000 for net assets that are worth $100,000. So we're going to take the $150,000, we're going to subtract the $100,000, which is the net asset value, right? So it's the purchase price minus the net asset value. That's going to give you the amount of the goodwill, which in this case is $150,000 minus $100,000. In this case, it's $50,000. Now, if you're purchasing a company, and this happens, a lot of small businesses are for sale, for example, you might pay more than the net assets. Well, you're going to account for that additional amount as goodwill. Now, goodwill is not amortized, but in some more advanced videos, we might talk about how that is treated after the first year. But let's look at how it's accounted for when the company is purchased. So the target company that is being purchased for $150,000 cash has the following assets. It has a building that's worth $180,000, and it has land worth $20,000. There is a mortgage on the land and the building, and they still owe $150,000 on that. And so there's going to be a note payable for the $150,000 that is still owed on the land and the building. The target company also has inventory that's worth $50,000. And we're going to assume, just for simplification purposes, that these are the only assets and liabilities of the company that is being purchased. In other words, the target company's assets and liabilities all are listed here. You could obviously have more. There could be accounts receivable. There could be all kinds of things that are in the purchase, but you'll get the idea when I journalize this. So we can start listing these assets, and we're going to do this journalizing from the point of view of the acquisition company. In this case, we're going to call it the takeover company. This is the company that's purchasing the other. So we're going to be gaining these land and building and inventory as assets. And since it's an asset, it's going to be debited, and we're going to debit them first. So we're going to first start with, we'll say building. And the building, we're debiting the full value of the building, which is $180,000. We also have the land. We're going to debit land, and that is for $20,000. We also are gaining inventory, and the fair value of the inventory, in this case, we're told is $50,000. We are paying cash of $150,000. That's what we're told. So we're going to credit cash. We're going to credit it for $150,000. And we're going to assume the liability of that promissory note of $150,000. So that's a note payable. So we're assuming that liability is part of this transaction, and that's also $150,000. So if we look at our transaction here, we've got 150 plus 150, we have $300,000 here. But on this side, if you add these up, this adds up to only $250,000. We are off by $50,000. What is that $50,000? Put it down in the comments if you know. That's right, it's goodwill. Goodwill is going to be $50,000, and I account for it with a debit because it is an asset. It's called an intangible asset. That means an asset that you can't actually touch, but it is an asset, and it will be treated as such. And we put that here as a debit because the acquiring company now owns that goodwill, and so our transaction now balances, and we now know what goodwill is, how it's calculated, and how to account for it. If you find that accounting is confusing for you, go ahead and smash the like button and let me know that. And if you have additional questions, put them down in the comments, and I can make a video to help answer your questions. And if you haven't already, please subscribe to my channel and click the notification bell so you'll know when the newest videos come out. Until next time, keep your grade alive and subscribe. Thank you.